Right now, as we watch the markets unfold on this active Thursday trading session, Supermicro Inc., ticker symbol SMCI, is trading live at $33.75 per share. We are seeing a modest intraday push to the upside of roughly 19 cents, translating to a gain of about 0.57%. The market is open, the order books are flashing, and the volatility is palpable. If you are watching your screens, you might see it flickering between 33.60 and 33.80, trying to find a solid footing after what has been a punishing few weeks for the stock. This immediate price action tells a story of a stock that is exhausted, perhaps trying to hammer out a bottom, or maybe just taking a brief breath before another leg down. The volume is already significant, pushing past 15 million shares, indicating that the battle between the bulls, who see value at these lows, and the bears, who fear further margin compression, is raging fiercely. Expectations for this company have been sky high for years. The general market narrative, the expectation, is that Supermicro Inc. is the primary infrastructure play for the artificial intelligence boom. Investors have been told that as long as Nvidia stock keeps climbing and as long as the demand for AI servers remains insatiable, SMCI will naturally drift higher, drafting behind the chip giants like a race car in a slipstream. The belief is that their plug-and-play rack-scale solutions are the shovel to the AI gold rush. However, the reality we are staring at today, with the stock lingering in the low $30 range, is far more complex and, frankly, far more concerning. The reality is that hardware assembly is a brutal, low-margin business, and Wall Street is waking up to the fact that revenue growth does not automatically equal profit growth. We are seeing a classic disconnect, where the top-line numbers, the sheer amount of sales, are growing, but the bottom-line profitability is getting squeezed by competition from giants like Dell and HPE. The expectation was endless scalability. The reality is a margin war. This tension is what makes the stock so dangerous and yet so compelling right now. Let's look deeper at what is happening on the chart today. That slight green tick of roughly 0.5% might look comforting to someone holding heavy bags from the $50 or $60 level, but we have to contextualize it. The stock is currently hovering perilously close to its 52-week lows of roughly $25.71. When a stock like Supermicro Inc., which was once the darling of the momentum trade, starts trading closer to its yearly lows than its highs, it signals a broken trend. The psychological damage to the shareholder base is immense. You have retail investors who bought in via their Robinhood app or their Fidelity investments accounts at much higher valuations, now wondering if they should cut their losses. The intraday movement we are seeing today is characteristic of a wait-and-see approach. Traders are hesitant. The aggressive buying we saw earlier in the year has evaporated, replaced by high-frequency algorithms and scalpers looking for pennies. The broader context for today's movement involves the entire semiconductor and hardware sector. We are seeing mixed signals. While Nvidia stock and other chip designers continue to command massive premiums, the box movers, the companies that actually build the servers, the racks, and the cooling systems, are being treated like commodities. This is the core of the issue. Supermicro has always prided itself on speed. Their business model is built on being the first to market. When Nvidia releases a new chip, Supermicro wants to be the first one to have a server rack ready to ship to a data center. That speed is their moat. But speed is expensive, and big competitors are catching up. The market is asking a very tough question today. Is Supermicro a technology company, or is it just a high-end manufacturer? If it is the latter, then a price-to-earnings ratio of 26 or 27 might actually be too high, not too low. This re-rating of the stock is what is causing the slow bleed we have witnessed over the last month, where shares have shed nearly 30% of their value. If you are sitting there with your Schwab Intelligent portfolios or managing your own individual brokerage account, you might be tempted to look at the buy ratings from analysts and think this is a steal. But we have to look at the recent earnings to understand the fear. The most recent quarterly report was a wake-up call. They posted net sales of roughly $5 billion. Now, $5 billion sounds like a lot, and it is. But the expectation was closer to $6 billion. More importantly, the gross margin, the percentage of revenue they keep after paying for the cost of goods sold, dropped to around 9.3%. This is the number that is scaring the institutional investors. In the hardware world, margins are everything. If you are selling billions of dollars of servers, but only keeping 9 cents on every dollar, your room for error is tiny. A slight increase in component costs or a slight delay in shipping can wipe out your profitability. The market hates uncertainty, and right now, Supermicro's margins are the definition of uncertain. We also have to discuss the AI server narrative versus the liquid cooling narrative. Supermicro has bet the farm on liquid cooling technology. The idea is that the new generation of AI chips runs so hot that traditional fans can't cool them down. You need liquid running through the server racks to keep them operational. Supermicro says they are the leaders in this. They expect a massive portion of new data centers to use liquid cooling. If they are right, and if they can maintain their lead, then the stock at $33 is a generational buying opportunity. But if the data centers decide to stick with air cooling for a few more years, or if they choose a competitor's liquid cooling solution, then Supermicro is left with a lot of expensive inventory and not enough buyers. This binary outcome is why the volatility is so high. It's not just about today's price, it's about a technological bet that will play out over the next 2 years. Let's pause on the technicals for a moment. If you use a Fidelity trading platform or interactive brokers to look at the charts, you will see a death cross formed recently, where the short-term moving averages crossed below the long-term averages. This is a bearish signal that often leads to further selling. The stock is currently stuck in a range. There is heavy resistance around the $40 mark. Every time the price tries to rally back up to $40, sellers step in, likely people who bought earlier and are just trying to get out at break-even or with a smaller loss. On the downside, there is some support around $30. If 30 breaks, the next stop could be that $25 yearly low. This is why today's action of holding $33.75 is so critical. The bulls need to defend this level to prove that the bleeding has stopped. Speaking of holding the stock, I'm curious about your position. Comment below how many shares of Supermicro Computer Inc. you currently hold and what your average buy-in price is. Are you underwater, or did you get in early enough that you are still in the green? It's always fascinating to see where the community stands on these volatile names. Now, let's broaden the scope to the ecosystem. Supermicro does not exist in a vacuum. They are heavily dependent on their partners, specifically Nvidia and AMD. When you hear news about Nvidia stock hitting new highs or facing regulatory scrutiny, you have to immediately think about how that impacts SMCI. If Nvidia is the engine, Supermicro is the chassis. You can't drive the car without the engine, but the engine needs a chassis to sit in. Recently, there have been rumors and reports about allocation. This is a fancy word for who gets the chips first. In a shortage, Nvidia decides which server makers get the coveted GPUs. For a long time, Supermicro was at the front of the line. But now, with Dell and HPE flexing their muscles and using their massive balance sheets to secure supply, there is a fear that Supermicro might get pushed back in the queue. If they can't get the chips, they can't build the servers, and they can't recognize the revenue. This supply chain anxiety is a constant wet blanket on the stock price. This brings us to the concept of self-investing and how retail traders are navigating this. Platforms like SoFi Invest and Robinhood have democratized access to these complex hardware stocks. 10 years ago, only institutional investors really cared about server rack manufacturers. Today, because of the AI hype, you have college students and retirees alike trading SMCI. This influx of retail capital adds to the volatility. Retail traders tend to be more emotional. They chase the rips and panic sell the dips. We saw this in the massive run-up in the year and the subsequent crash. The smart money, the hedge funds and family offices, often use this retail liquidity to enter and exit their positions. When you see a sudden spike in volume on no news, it's often a changing of the guard between these two groups. Let's talk about the business model again because it's often misunderstood. Supermicro is not just a manufacturer, they are an engineering firm. They call it building block solutions. Instead of selling you a standard server, they let customers mix and match components to build a custom solution. This is great for flexibility, and big tech companies love it because they have very specific needs. However, customization is inefficient. It's harder to automate the assembly line when every order is different. Dell, on the other hand, prefers to sell standardized boxes. They might not be as flexible, but they are incredibly efficient. In a booming market, customers pay extra for flexibility. In a tightening market, they prioritize price and standard availability. As the AI market matures, we might see a shift from custom high-end engineering to standardized, mass-produced commodity servers. If that happens, Supermicro loses its main advantage. We also need to address the recent financial targets. Management has put out a very bold forecast, aiming for huge revenue targets, upwards of $36 billion for fiscal year 2026. This is the carrot they are dangling in